Hi, I'm Mark Pizzicaller and welcome to this edition of 3 Minutes with Mark. What I'd like to briefly discuss today is the Healius decision. It's a recent case that came out. It's a $2 billion company listed on the stock exchange. One of the things it does is that it buys and runs medical centres. Now, you might think, what's so exciting about that? Well, what's so exciting is that when it purchased these medical centres, it was claiming an income tax deduction for the centres. Ordinarily, in these circumstances, when you're buying a business, as many of you would know, that's on capital account and not deductible. What made this different? Well, when it was purchasing these medical centres, it was actually arguing that, look, these expenses that we're incurring are regular outlays. We're buying medical centres all the time. It's part and parcel of our business. These should be on revenue account. Also, when the doctors come across with the medical centres, we've only got them for a 5-year period, so they're not here forever, and therefore the expenditure is recurrent in nature. The Commissioner looked at it and said, well, find that hard to believe because you're actually buying medical centres. It's usually on capital account. You're making lump sum payments. They should be on capital account and non-deductible. The other thing too is that this is your business. Your business is to purchase these medical centres. Now, when the judge looked at all of the facts and arrived at his own conclusion, he looked at it and said, well, I think it is capital. I think it is non-deductible. The purchase of the medical centres were not part of the business structure of the company. And also, effectively, it was running a service company. In other words, even though it was purchasing the medical centres, it wasn't delivering medical services to the customers. In fact, it wouldn't be liable for any negligence claims. And so based on all those factors, the judge concluded, and it was a single judge, that it was revenue account, deductible, and the case went to the taxpayer, which is a good result for the taxpayer. But a real interesting decision. How fascinating is that? That you can buy something, call it a sale agreement, and the judge can look at it and say, well, you've called it a sale agreement, but it's not really. Fascinating. See you next time.